The stock market in 2023 has pretty much been consistently bullish. There has been a couple days here and there where stocks sell off, but it's been pretty good so far. Nobody can lie, it's been a lot better so far in 2023 than what you've seen in 2022. And this comes down to the Fed pausing and ultimately cutting later in the year. That has been the overarching thesis of this market in 2023. What we heard from Fed Jerome Powell today, quite the opposite. And we're going to get into exactly why the stock market fell about 1.5% today. What are the major catalysts throughout the rest of this week, and what do you need to watch out for? And a lot more. So the work is cut out for us. Let's get to it. This paragraph right here, let me just highlight it for you guys. Right here. We're going to read it. This is the reason why the markets fell today and will likely continue to fall over the next couple of days. Now, keep in mind, Fed Jerome Powell had this congressional hearing today. It will also be tomorrow at 10 o'clock in the morning on March 8th. And then it will be over. And then it's all up to the data. So, quote, this is from Fed Jerome Powell. The latest economic data has come in stronger than expected, which suggests the ultimate level of interest rates is likely to be higher than previously anticipated. Quote, if the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate increases. Fed Jerome Powell took a massive crap on the markets today. The exact reasons why investors have been investing in the stock market in 2023, number one being the odds of a recession going down, the odds of a severe recession dramatically going down since the start of 2023, inflation coming down, the Fed ultimately being close to a pause and then subsequently cutting rates by the end of 2023. All of those three things that have been causing investors to buy stocks in 2023 dramatically just came to an end. And Fed Jerome Powell literally says that they will increase the pace of rate increases if the economic data and the reports that we get over the next couple of weeks indicate that they should do that. Now, let me take it a step further, because investors, you know how we like to roll. We like to try to guess what the Fed's going to do next. And investors, as of today, are starting to think that Fed Jerome Powell is putting these things in writing because they want to do a 50 basis point rate hike, or maybe even a 75 basis point rate hike, because investors are speculating that Fed Jerome Powell already knows the initial jobless claims coming out tomorrow is going to be hot. They know the unemployment rate is going to be hot Friday morning, and they also know the non-farm payrolls are going to show a lot more jobs are being added to this economy, again, coming out on Friday. A lot of people are speculating Fed Jerome Powell already knows the inflation report coming out next week is going to be hotter than expected. So somewhat preparing the markets for larger rate hikes again. Going against the thesis of why investors are owning stocks. Now, don't get me wrong, I like to be an investor all the time. I don't like to be an investor one year and not the next and buying bonds. I'm not going to do all that. And I'm not going to say anyone should do all that. Obviously, I'm not a financial advisor. Come to your own conclusions, all of that good stuff. You guys already know the deal. Don't invest based off of someone's opinion on YouTube. But this don't look good. This is not good for the overall narrative that we've had in 2023 so far. And ultimately what this boils down to is the Fed raising rates higher than what we expected leads the odds of a recession to also go higher, and the severity of that possible recession to be a little bit worse. Now, in the December FOMC statement, there's the summary of economic projections where you get the dot plot of where Fed speakers want interest rates to be by the end of the year. And the terminal rate as a consensus whole, or an average, however you want to call it, was for a terminal rate of 5.1%. A terminal rate means the highest the Fed funds rate is going to go before a cut. So essentially means the peak rate. was 5.1%. Now today, after Powell's remarks, we're now expecting in between 5.5 and 5.75% for the federal funds rate, effectively pricing in an extra 0.5% rate hike here today. And if you take a look at the Fed Rate Monitor tool, this is a tool I highly suggest everyone pay attention to because, I mean, it's important to know what markets are pricing in. And every single time in 2022 and over the last 40 years, the Fed listens to this rate monitor tool, what the bond market is pricing in, because they don't want to upset expectations. If they can talk Fed policy higher, then they can raise rates more because, again, it's priced in, it's expected. You went from a 28.4% chance yesterday of a 50 basis point rate hike at the next March 22nd meeting, now to 69.8% chance of a 50 basis point rate hike. But the worst part about all of this, not trying to be the bearer of bad news here necessarily, is if you get hot unemployment reports this week, the hot payroll reports, you get hot CPI next week, this is going to go to a 75 basis point rate hike faster than you realize it. Just consider what happened today off of a single paragraph that Fed Jerome Powell said. So that's the real reason why the markets are selling off here today. And what could this mean for stocks and the overall indexes over the next couple of days and next couple of weeks? Well, it all depends on, obviously, the course of data. The next major levels we have to contend with are the one that we are at right now, the 50-day moving average at $398.31 on the S&P 500. We closed, or are about to close, after hours trading at $398.42. So hardly above this 50-day moving average. That is a positive thing. But even where we were 3 trading days ago was at about 390, right? 391 was that support level that we held just a couple trading days ago. That would be, furthermore, about a 1.5% decline again to get down to that level. Now, if you break under that level, then you very well could be at the 375 range before you know it. And a lot of people would say that's a much better fair value for the S&P right now, considering all of the headwinds that we are facing, and now the fact that inflation looks to be on another move higher. So, long story short, the Fed crapped on the markets today, and until we get economic data that suggests the Fed should not raise rates more aggressively at this point in time, the markets are probably going to get pretty sour pretty quickly. Now, Fed Jerome Powell also gives another speech, like I said earlier, tomorrow at 10 o'clock in the morning. He's going to look at everything we just talked about here in this video. He's going to look at what the markets are now pricing in, all of this, and recalibrate how he says things. So tomorrow, he could give you a little bit of a more relaxed stance on where economic data is going, or he might try to get the markets to price in more. So I think Fed Powell accomplished what he wanted to. I don't expect any more verbiage to be hawkish or dovish coming tomorrow. I don't think we're going to get new information. But it is a risk and it is a possibility. And that is going to be tomorrow morning, as well as that you do get the balance of trade as well, and the JOLTS job quits as well as the JOLTS job openings. You are expecting 10.6 million job openings, down about 400,000 from the report that we got in January, where there was 11 million job openings. Now, you also get the Bank of Canada interest rate decision. Now, the markets are expecting Canada to pause. They're not expecting a rate increase. Canada has surprised us before. So if you do get the Bank of Canada actually raising rates when they're expecting to pause, that's not going to send a good sign for our Fed policy and the next Fed decision coming March 22nd. So I think that could potentially be a big catalyst as well. Now, I'm right here, 8:30 in the morning on Thursday, initial jobless claims for March 4th. You were expecting 192,000 initial jobless claims. Last week's reading, was 190,000. So you are expecting a slight uptick, but nothing too crazy. And then the big economic data coming Friday morning, 8:30 in the morning, is the non-farm payrolls, last month's reading, seasonal adjustments, blah, blah, blah. People, we've talked about this before. 517,000 jobs added in January. You are expecting 210,000 jobs to be added this time around. If it comes in hotter than that, that's going to be a problem. The unemployment rate came in last month at 3.4%. You're again expecting 3.4%. If it does go lower, again, it's going to say the Fed has more work to do, thus should mean lower stock prices. Now, I don't say this to be doom and gloom. I say this to tell you that there's a lot of opportunity in where we are currently at. I think the best thing I'm personally looking to do is just hold some cash, hold some extra cash, maybe 20-25% cash if possible, to wait for these dip opportunities, because I do think this is the start of something that might not be so good for equity markets. Leave your comments, questions, or concerns down below in the comment section. If you made it to the end of this video, most certainly hit that like button and subscribe to the channel. Thank you for watching, and I will see you in the next one.